France just emptied every single ounce of gold it had stored at the Federal Reserve, 129 tons, gone. And the explanation they gave is one of the most revealing things a central bank has said out loud in decades. Not because it's honest, but because of how transparently dishonest it is. At the same time, gold trading at all-time highs above $5,500 an ounce collapsed 20% in a matter of weeks. The single worst weekly decline since 1983, during an active war in the Middle East, during an oil shock, during precisely the environment where every financial model, every textbook, 50 years of market history says gold goes up. These two things are not unrelated. They are two visible parts of a single underlying story. And that story is about who controls the price of gold, how they control it, why they moved it in this direction at this specific moment, and what the institutions that truly understand this market are doing right now while most investors are asking the wrong questions. Everything I'm about to walk you through is visible in public data, exchange filings, central bank reports, vault inventory records, capital flow data. The reason most investors don't see it isn't because it's concealed, it's because the pieces are reported separately in different contexts by different outlets, and nobody connects them. That's what I'm going to do right now. The gold market has two distinct layers that most investors conflate, and conflating them is the single most expensive mistake you can make. The first is the paper market, the COMEX futures exchange in New York, where financial contracts representing 100 ounces of gold each are traded continuously by hedge funds, algorithms, and investment banks. This is the market that sets the price you see quoted everywhere. The critical fact, the one that changes, is that approximately 95% of COMEX contracts never result in physical gold changing hands. They are paper claims, and the total value of those paper claims significantly exceeds the physical gold actually available for delivery. This is not a secret. It is the architecture of how the modern gold price is set. The second layer is the physical market, London's LBMA vaults, the Shanghai Gold Exchange, central bank transfers. Less liquid, less visible, far less discussed. But this is where the real long-term signal lies. Here's what happened after the Iran conflict broke out. The CME Group shifted margin requirements from a fixed dollar amount to a percentage of contract value. It sounds technical, it isn't. It meant that as gold prices rose, margin requirements rose automatically, a structural amplifier built directly into the market's architecture. Then within 2 weeks, margin requirements were raised 3 separate times. This created a lethal asymmetry. JP Morgan, Goldman, CBC, institutions with virtually unlimited balance sheets, absorbed those hikes without difficulty. For smaller hedge funds and retail futures traders, it was existential. They couldn't post the additional collateral. They had no choice but to sell. Their selling drove prices lower. Lower prices triggered margin calls on other leveraged positions. More forced selling. The price dropped further. More margin calls. A liquidation cascade. A mechanical self-reinforcing spiral with nothing to do with gold's fundamental value. Now, ask the obvious question, who benefits? The well-capitalized institutions who weathered the storm got to buy what smaller players were forced to liquidate at distressed prices. This is the oldest transfer mechanism in institutional finance. The exchange calls it a routine volatility review. Mathematically, that's not wrong. But the outcome, small participants liquidated. Large participants accumulating, was entirely predictable from the structure of the decision. That was the first force. 3 others hit simultaneously. Turkey imports 90% of its oil. When the Middle East conflict drove oil past $110 per barrel, Turkey's energy import bill spiked by billions almost overnight. With the lira already fragile and reserves insufficient, Turkey faced a simple choice: currency crisis or sell gold. Turkey sold between 60 and 120 tons in a matter of weeks. For context, total global gold ETF outflows during that same period were approximately 43 tons. Turkey alone exceeded everything being widely reported as the cause of the price decline. The Gulf states faced a structurally different but mechanically identical problem. Their dollar pegs require dollar reserves. Those reserves are normally replenished by oil export revenues. When conflict disrupted Strait of Hormuz shipping export revenue slowed while the peg obligation remained. The gap had to be filled by liquidating gold. The outflows recorded from London LBMA vaults were consistent in scale and timing with large-scale Gulf sovereign selling. The third force was the dollar, and this is counterintuitive. The relationship between gold and the dollar inverts during acute geopolitical crises. When severe risk materializes suddenly, global capital floods into US treasuries. That demand strengthens the dollar, and since gold is priced in dollars, a strengthening dollar mechanically suppresses gold for every non-US buyer. The transmission chain ran like this. Conflict drives oil higher. Oil drives inflation expectations up. The Fed can't cut into an inflationary environment. Elevated US rates attract global capital. Dollar strengthens. Gold falls. Institutional algorithms programmed to sell when real yields rise execute at scale. The cascade fed itself. Now, the fourth force, the one that reveals the full strategic logic, 129 tons of French gold sitting at the Federal Reserve since 1920, removed completely between July 2025 and January 2026. The official explanation from the Banque de France: the gold was old, non-standard, didn't meet current market specifications. France sold it in New York and bought compliant gold in Europe, now stored entirely in Paris. This explanation does not survive scrutiny. Every prior repatriation from New York, Germany's documented program from 2013 to 2017, the Netherlands, Austria, was conducted by physically shipping bars, standard transfers. Nobody sold and reburied. That's not how you move your own gold home. That is how you convert a claim on gold into cash and buy gold somewhere else. You only do that if a physical transfer is impossible, either because logistics are prohibitive, which they are not for bar transfers of this type, or because the gold you're claiming cannot actually be delivered. I want to be precise. This is an interpretation, not an established fact. The interpretation is that France requested repatriation, found physical delivery wasn't possible, accepted a cash settlement, and agreed with the Fed on a cover story that describes it as a compliance upgrade rather than a failed delivery. Both parties had every incentive to agree on that narrative. The Fed doesn't want to acknowledge a delivery failure. France doesn't want to acknowledge its gold holdings may have been compromised. What is not an interpretation is what happened next. Prominent German economists and lawmakers immediately began publicly calling for Germany to repatriate its gold from the United States. A former Bundesbank economist said on the record that storing gold in the US carries geopolitical risk. Germany still holds approximately 400 tons at the Federal Reserve. That debate is now active. This rhymes with 1965. De Gaulle dispatched a French battleship to New York to exchange dollars for gold under the Bretton Woods system. Other nations followed. The gold outflow became so severe that by August 1971, Nixon unilaterally closed the gold window. The Nixon shock, the end of Bretton Woods, the beginning of the dollar as reserve currency architecture that has governed global finance for 50 years. I am not predicting a repeat, but the underlying dynamic, foreign sovereigns losing confidence in America as a custodian of their gold, and the consequences of that lost confidence are not structurally different. Here's what was happening in the physical market while the paper market was crashing. COMEX registered inventory, gold, actually available for delivery, fell approximately 25% during the paper price decline. Physical gold was leaving the system at an accelerating rate at exactly the moment the paper price was most suppressed. Physical gold does not disappear because a futures contract was sold. The metal is real, the paper claim is not. Meanwhile, in China, something occurred that received virtually no coverage in Western financial media, and which I believe is one of the most significant gold market events of the past decade. China's financial regulators authorized 10 major insurance companies, including PICC and China Life, to invest up to 1% of their total assets in gold. 1% sounds modest. These are institutions managing trillions of renminbi. The estimated potential demand from this program alone is approximately $27 billion. Half the participating companies have already begun deploying. The industry is nowhere near its authorized limit. If the pilot extends to additional institutions, which the regulatory framework explicitly contemplates, the scale grows substantially from there. Chinese gold ETF inflows remained resilient throughout the period when North American ETFs were hemorrhaging outflows. The Shanghai premium over COMEX paper price stayed elevated. The signal from the Chinese physical market was unambiguous. At lower prices, Eastern institutional buyers were accumulating aggressively. This is the structural asymmetry that defines this moment. Western paper market participants facing margin calls were selling. Eastern physical market participants, unleveraged with long investment horizons, were buying. The price Western holders were panicking about was, from the perspective of Chinese insurance companies and Asian central banks, a procurement discount. This has a name in market structure analysis: the transfer of assets from weak hands to strong hands. Weak hands hold assets on leverage and can be forced to sell. Strong hands hold assets outright, treat price declines as opportunities, and have the time horizon to wait. What we observed was a mechanically engineered large-scale transfer. The engineering was done through margin policy. The beneficiaries were the participants who controlled or could withstand that environment. Now, the broader strategic logic, because understanding individual events is less useful than understanding the system that produces them. In February 2022, the United States froze approximately $300 billion of Russian central bank reserves. Whether justified is a separate question. The consequence, the one quietly reverberating through every sovereign wealth fund and central bank on the planet since that moment, is the demonstration that dollar-denominated reserves are not inviolable, they can be frozen. Their availability is conditional on your geopolitical relationship with Washington, Poland, Kazakhstan, Brazil. India, China, the countries purchasing gold at the fastest pace in decades, are not running models showing gold will appreciate. They watched what happened to Russia and drew a rational conclusion. If your national wealth is held in a system controlled by a potential adversary, that wealth is not fully yours. Physical gold in your own vaults, subject to no counterparty's discretion, is the only reserve asset that cannot be frozen, seized, or blocked by foreign policy. This is de-dollarization, not ideology, not anti-American sentiment, rational sovereign risk management in response to a demonstrated precedent. Now, the second-order effects, because the immediate price movement is not the story. COMEX registered inventory is declining. Physical demand from Eastern buyers and sovereign accumulators is rising. The pool of leveraged Western paper holders who can be margin called into selling is finite, and every liquidation event shrinks it further. At some point, the paper market's ability to set a price that diverges from physical reality will reach its structural limit. When that constraint binds, the convergence will be rapid and large. The Fed is currently frozen between inflation that prevents rate cuts and growth weakness that demands them. But the arithmetic of $38 trillion in government debt, with a large portion requiring refinancing at current rates, creates a fiscal pressure that sustained high rates cannot resolve the eventual resolution. Is lower real rates, more monetary accommodation, and a weaker dollar? That is the environment where gold's long-term bull case fully materializes. Here is the central psychological challenge. Gold declined 20% from its all-time high. That is real and uncomfortable, but ask the question that actually matters. Did anything change about the fundamental conditions? Did the US fiscal deficit improve? Did central banks globally reverse their gold accumulation? Did the physical market signal oversupply? Did the de-dollarization trend reverse? None of those things happened. What happened was a mechanical event in a leveraged paper market, amplified by sovereign force selling from an energy shock, operating through a temporary dollar strengthening mechanism. The structural case was not changed by this event. From a long horizon perspective, it was given more time to accumulate at lower prices. The investors positioned to benefit from the eventual paper to physical convergence are not the ones watching the daily COMEX price and reacting. They are the ones who understand the difference between a mechanical paper market event and a structural change in the underlying thesis, and have the discipline not to confuse the two. Watch the signals that actually matter. Vault inventory, physical demand data, sovereign accumulation flows, the paper versus physical divergence, not the daily noise of a leveraged paper market that is, by design, not a reliable reflection of the asset. It is supposedly pricing. France moves its gold to Paris. China authorizes its insurance companies to build the largest gold allocation in the country's history. Central banks across the non-Western world continue purchasing over 1,000 tons per year. The CME adjusts margin policy in ways that flush leveraged retail and allow well-capitalized institutions to accumulate at distressed prices. These are not random events. They are the coordinated behavior of actors who understand that the global monetary architecture is in the early stages of a transition away from unipolar dollar dominance toward a more distributed reserve system where physical gold plays a larger role than at any point since 1971. Whether that transition completes in 5 years or 20, nobody can say. What can be said is that the direction is determined by forces that are not weakening, they are strengthening. The paper market is fighting a rearguard action against a physical reality that is increasingly difficult to suppress. The plan is real, it is visible. And it is being executed right now at exactly the prices the paper market suppression mechanism has created.